Picture this. You've just hit a number you've been chasing for years. Maybe it's your first $100,000 saved. Maybe it's a net worth north of $500,000. Maybe you finally paid off the house, or sold a business, or got a promotion that bumped your income into a tax bracket you used to think was reserved for other people. And instead of feeling free, instead of feeling like you finally crossed the finish line, there's this weird, creeping anxiety that wasn't there before. Like you're suddenly holding something fragile and expensive and you're not quite sure you're allowed to be holding it. That feeling? It's not imposter syndrome exactly, it's something else. Something most personal finance content won't talk about because it's easier to sell you on 10 ways to grow your wealth than to sit down and say, hey, the further you climb, the more sophisticated the traps get. And a lot of people, smart, hardworking, genuinely financially literate people, step right into them. My name is Jordan, and I've spent an embarrassingly large portion of my adult life thinking about money. Not just investing or budgeting, but the psychology of it. Why people with real wealth sometimes feel more financially anxious than people living paycheck to paycheck, and why the habits that helped you build net worth are sometimes the exact habits that start working against you once the number gets big enough. I find it fascinating and a little terrifying, honestly. What I want to do today is walk through the financial traps that don't just persist as your wealth grows. They actually get worse. The stakes get higher. The social pressure gets more intense. The emotional math gets more complicated. By the end of this, I want you to be able to look at your own financial life and spot the places where growth might actually be creating invisible drag. Because awareness, as cliché as it sounds, really is the first move. Let's get into it. Okay, so lifestyle inflation is not a new concept. You've heard about it? I've heard about it. We all nod along when someone mentions it. But here's what people consistently underestimate. Lifestyle inflation doesn't just happen once. It's not a single bad decision you make when you get your first raise. It is a continuous, self-reinforcing system that recalibrates every single time your income or net worth moves up a level. When you were earning $40,000 a year, you drove a used car, lived in a modest apartment, and cooked at home most nights. Then you got to $80,000 and you upgraded. Reasonably, deservedly. You got a nicer place, went out to dinner more often, maybe bought a new car. And because your income doubled, you still felt financially responsible. The math still worked. But then you hit $150,000 and the whole game shifts again. Suddenly, the neighborhood you live in feels a little mismatched with where your colleagues live. The car that felt new 3 years ago starts feeling a little embarrassing at the valet. Your vacations, which used to feel luxurious, now feel kind of ordinary compared to the people in your orbit. This is the part that makes lifestyle inflation so insidious at higher income and wealth levels. It stops being about comfort and starts being about calibration. You're not buying a nicer car because your old one broke down. You're buying it because your unconscious brain has recalibrated what normal looks like. And that recalibration happens faster than you think and costs more than you'd ever voluntarily admit to spending. I read a study once, I think it was out of Princeton, though I might be misremembering the source, that found that life satisfaction improvements from income kind of plateau around a surprisingly low number. But what's interesting is that subjective financial stress doesn't follow the same curve. Rich people can be extraordinarily stressed about money, not because they don't have enough, but because their baseline of enough has expanded to match their income. The finish line moves with you. The fix isn't to live like a monk. It's to be intentional about the upgrades you actually choose versus the ones that just happen because your environment changed. There's a huge difference between deciding, I want to spend more on travel because it genuinely brings me joy, and waking up one day realizing your monthly expenses have silently doubled. Here's something nobody warns you about. The more assets you accumulate, the more complicated your financial life gets. And that complexity carries real costs. not just in time and mental energy, but in actual dollars. Think about it. When you have $10,000 in savings, your financial picture is simple. One bank account, maybe a 401k. Taxes are straightforward. You can manage it yourself in an afternoon. But then you add a brokerage account, then a rental property, then stock options from a job, then a business, then a trust for estate planning purposes, then a 529 for the kids, then, oh wait, you moved states and now you have 2 state tax filings because your rental is in a different place than where you live. And somewhere in there, your simple financial life has become a sprawling, interconnected web of accounts, obligations, and decision points that genuinely requires professional management. Which brings me to the actual trap. People who have accumulated real wealth often undermanage the complexity. They don't want to seem like they need hand-holding. They're smart. They've read the books. They've done it themselves this far. So they avoid getting proper help, and they miss things, important things. Tax optimization strategies they didn't know existed, insurance gaps in their coverage, beneficiary designations on accounts that haven't been updated in a decade and still list an ex-spouse. The other side of the trap, and this one's almost worse, is people who respond to complexity by over-delegating. They hand everything to a financial advisor and basically stop paying attention. Which sounds responsible until you realize that some advisors operate on fee structures that are quietly eroding your returns or are steering you toward products that are better for their commission than for your portfolio. This one is underrated. Genuinely. I don't hear enough people talk about how wealth that exists in illiquid form creates a very particular kind of stress and a very particular kind of vulnerability. You might have a net worth of $2 million. Sounds great. But if $1.5 million of that is in your primary residence, $400,000 is in retirement accounts you can't touch without penalties for another decade, and $100,000 is in a small business that has no realistic buyer right now, you actually have very little financial flexibility in the short term. You're asset rich and cash poor. And that gap between what you're worth on paper and what you can actually access creates a kind of invisible financial fragility that high net worth individuals don't talk about enough. The trap gets worse as wealth grows because the assets tend to get less liquid over time, not more. You buy real estate, you invest in private placements, you get equity in a startup, you lock money into annuities or whole life insurance products. All of these might be legitimate moves, but they quietly reduce the amount of financial flexibility you have in an emergency. And here's the real danger. When you look at your net worth number and feel wealthy, you make decisions that match that feeling. You don't keep a cash emergency fund because, come on, you have assets. You don't think twice about a big expense because surely you could liquidate something if you needed to. Except liquidating something in a hurry almost always means selling at the worst possible time, paying penalties, or incurring massive tax consequences. I've talked to people with 7-figure net worths who genuinely could not cover an unexpected $50,000 expense without either selling something at a loss or going into debt. That's not a hypothetical. That happens. And it happens specifically because the illusion of wealth, the big number, creates behavioral overconfidence about real financial security. Keep an honest ledger of what you could actually access in 30 days without catastrophic consequence. Okay? Taxes. I know, everyone's least favorite topic. But stay with me because this one genuinely gets more dangerous the more money you make, and the danger is almost never what people expect it to be. The most common mistake I see isn't that people pay too much in taxes. It's that they pay too much in taxes while thinking they're being strategic because their tax planning is entirely defensive and backward-looking. Here's what I mean. Most people think about taxes once a year, in the spring, when they sit down with their accountant or open TurboTax. At that point, the decisions have already been made. The income was already earned. The accounts were already contributed to. The investments were already sold. All you're doing at that point is reporting history. You're not actually making strategy. You're just filling in the boxes. As your net worth grows, the gap between what you pay with passive, backward-looking tax management and what you would pay with forward-looking strategy gets enormous. We're talking tens of thousands of dollars a year for some households. Sometimes significantly more. Things like tax loss harvesting, Roth conversions in low-income years, timing capital gains across calendar years, qualified opportunity zone investments, charitable giving strategies that are actually structured well. These aren't loopholes. They're legal mechanisms that exist specifically to reward people who plan ahead. But they require planning ahead, which means thinking about taxes in June and October, not April. The reason this trap gets worse with net worth is simple. Higher net worth typically means more complex income streams, more capital gains exposure, and more at stake in every decision. The percentage of your wealth that could be optimized or lost through tax decisions grows disproportionately. Meanwhile, most people's tax strategy doesn't grow with them. They still think about it the same way they did when they were filing a W-2 and maybe a 1099. Find a CPA who does proactive planning, not just filing. There is a difference. Ask them, what should I be doing differently right now before the end of the year? If they can't answer that question in a way that feels strategic, you might be working with the wrong person. This is the one I find most psychologically interesting and honestly the most painful to watch happen to people. When you don't have much money, social comparison is real but limited. You might feel a little envious of a friend's nicer apartment or someone's new car. It stings, but the gap feels somewhat comprehensible. You know roughly what things cost, and the distance between where you are and where they are feels closable. But once you start accumulating serious wealth, the comparison game shifts into a completely different league. Because suddenly you're in rooms, actual rooms, or metaphorical ones, with people whose wealth is an order of magnitude beyond yours. And wealth, at high levels, is almost impossible to fully perceive because so much of it is invisible. You might have $2 million in net worth. Congratulations, genuinely. By almost every global standard, you are extraordinarily wealthy. But if you're in a social or professional environment where the baseline is $10 million, you start to feel poor. Not just relatively poor, genuinely, psychologically poor. Like you haven't made it yet. Like you're still working toward something. And that feeling is wildly disconnected from any objective reality. The trap here is that this comparison drives decisions. It drives people to take on more risk than is appropriate for their situation because they feel behind. It drives people to spend in ways that signal wealth rather than build it, because in social environments where wealth is the currency, you perform it. Private schools, not because of the education, but because of the network. The vacation to the right place because you'll be asked about it. The club membership you don't actually use. I've seen this destroy people financially. Not dramatically, not overnight, but slowly. Trying to live at the level of your social context when your assets don't actually support it, decade after decade, until the math eventually forces an uncomfortable reckoning. The antidote is deeply personal and genuinely difficult. You have to define what enough means to you, independently of your environment. Not what your neighbor has. Not what your college roommate posted on LinkedIn. What do you actually need to feel financially secure and live in a way that feels aligned with your values? Write it down. Last one, and this might be the trap with the highest stakes. When your net worth grows, especially if it grows quickly, there's an almost unavoidable psychological side effect. You start to believe you're good at this, that the growth is a reflection of your skill, your judgment, your sophisticated understanding of markets and money. And to be fair, some of it probably is. But a significant portion, especially over the last decade or so, has been market conditions. A rising tide that lifted most boats. The danger is that success in investing, especially when it's been relatively easy, builds confidence that isn't actually calibrated to your real skill level. And that overconfidence tends to express itself in predictable ways. Taking on more concentrated risk than is wise, dismissing diversification as something for people who don't understand what they own, chasing the next big thing because the last one worked out. Angel investing in friends' businesses, going heavier into crypto or speculative stocks or private equity deals without a full understanding of the risk profile. The truly brutal part of this trap is that it can take years to reveal itself. You might make aggressive, undiversified bets for 3 or 4 years and continue to win, not because you're right, but because the market continues to rise. And each year of success further hardens the overconfidence, until one year it doesn't work. And the losses are catastrophic in a way that a diversified, boring portfolio would never have allowed. I'll say something that sounds obvious but apparently needs to be said. Your track record in an extended bull market is not a reliable indicator of your investing skill in a neutral or bear market. The feedback loop of growing net worth is not always honest feedback. Stay humble about what you don't know. Keep a meaningful percentage of your assets in boring, diversified instruments, even if they feel beneath you. Risk management isn't pessimism. It's how you keep the wealth you work to build. All right, so let's tie this together, because I don't want this to feel like a list of warnings and walk away. The through line in every trap we talked about today is this: the skills, habits, and mindsets that help you build wealth are not automatically the ones that help you preserve and grow it intelligently. At some point, and this point is different for everyone, you have to update your financial operating system. You have to recognize that the game has changed. Lifestyle inflation scales with you if you let it. So be intentional about your upgrades instead of letting them just happen. Complexity grows faster than people expect, so get real professional help and stay curious about your own financial picture. Liquidity matters in ways that net worth on paper doesn't capture. So know what you can actually access when things go sideways. Tax planning is a year-round discipline, not a spring ritual. Treat it that way. Social comparison at high wealth levels is profoundly distorting, so define your own version of enough before the environment defines it for you. And overconfidence is a natural product of success, which makes it genuinely difficult to spot in yourself. So stay humble and stay diversified. None of these are things that people teach you when you're starting out, because when you're starting out, the only lesson that matters is save more, spend less, invest consistently. That advice is true and important. But at some point, the training wheels have to come off. And the next level of financial intelligence is less about accumulation and more about not accidentally destroying what you've built. You worked hard to get where you are. These traps don't care about that. They don't distinguish between the cautious and the careless. They just scale with your net worth and weight. The good news, and I mean this genuinely, is that awareness changes behavior. The fact that you're here thinking about this stuff, engaging with these ideas critically, that already puts you ahead of most people. Not because knowledge is magic, but because the people who tend to fall hardest into these traps are the ones who stopped questioning their own financial assumptions the moment things started going well. Stay curious, stay honest about your blind spots, and build something that lasts.